So in this video we'll take a look at why people spread bet. At the end of the day you could simply buy an asset and wait for it to rise in price. Tesco shares for example. But actually spread betting offers potentially a faster, cheaper and leveraged, higher risk but higher return way of achieving the same thing. So let's take a look at why you might choose a spread bet over, say, buying shares. After all, both can be used to bet on rising prices. You either buy shares and wait, or you take what's called a long position with a spread bet, which is effectively an up bet on the direction of something else, such as Tesco shares. So how would you make that decision, and what are the pros and cons of either route? Well, first of all, let's pick something to bet on. So imagine that is Tesco shares. And we're looking at two possibilities. So one would be simply to buy the shares themselves. The other one would be a spread bet on Tesco through a spread betting broker. Now, leaving aside for a moment the mechanics, how would you make that decision? Well, it's a case of weighing up the pros and cons, and there are several. First of all, when you buy shares, a bit like buying property, you pay a rather annoying tax called stamp duty. So, if you're buying shares, stamp duty, normally paid at 0.5% of the purchase price, kicks in. With spread bets, there's no stamp duty. So it's only a small saving, but if you're a regular trader, that can add up. Then you've got a second tax, capital gains tax, or CGT. That's the tax you pay when you make a profit, not just on shares. But the problem is, unless you hide your shares in something tax efficient, such as an individual savings account, you'll be paying capital gains tax. So that kicks in there as well. Here's some good news. Not when you spread bet. You can make profits as big as you like with spread betting, and there's no capital gains tax to pay. What about commissions? So when you buy shares, for example, you'll be paying a commission to your broker. Now that could work out a number of ways. It might be £10 to buy, £10 to sell, maybe a little less if you trade regularly, but you'll be paying that commission every time you trade. With a spread bet, you don't pay commission as such. It's not free, spread betting brokers are not charities, but you don't pay a commission in the same way as you would with shares. So what do you pay? Well, when you buy and sell anything in financial markets, you normally do so at two different prices, the bid and the offer price, because the person doing the trade with you, your broker, is trying to make money. It's like second-hand cars. You go into a car dealer and mysteriously the same car has two prices. One if you're trying to buy it off the dealer, not surprisingly the higher price, and the other one if you're trying to sell the same car back to the dealer, the lower price. So just as second-hand car dealers operate bid-offer spreads, so does everybody across financial markets pretty much, including your broker. So when you buy shares, you will suffer what's called a bid-to-offer spread. So for example, if the so-called mid-market price of Tesco is £4.25, you might think, well, that means I can buy and sell it at £4.25. No, you'll probably be paying a little bit more than £4.25 to buy, and you'll get a little bit less than £4.25 to sell. And that's a feature of buying and selling shares. The name suggests it must also be a feature of a spread bet, and indeed it is. And that's something to watch out for. You will pay to spread bet, but you'll do it through the bid to offer spread, normally rather than separate commissions. Okay, what else? Well, one advantage of spread betting is so-called leverage or gearing. And what I'm going to suggest here is that when you buy, say, 1,000 Tesco shares at £4.25, you'll be paying the full purchase price up front. That will be around £4,250. However, spread betting, you can basically take a position of a similar size, but with a much smaller upfront commitment. And it's that ability to leverage up a spread bet that gives it both its up and downside. It makes it a fantastic way to make quick profits, but also, if you're not sure what you're doing, quite a quick way to lose money too. So you will pay the full price to buy shares, as you'd expect. You don't actually commit the same amount of cash to spread bet. Now, to round off, just one other thing to be aware of, and that is shareholder perks. The biggest one is probably dividends. With a share, you also get the right to sort of vote at Tesco's annual general meeting, for example. The point about owning shares is you get them. So if you hold Tesco shares when a dividend is paid, you'll normally snap that up. Spread bettors don't normally get the same rights as shareholders. So you don't become eligible to vote at meetings, for example, if that's important to you, and you wouldn't normally qualify to receive any dividends for the length of time your bet is open. So in essence, spread betting. 3 real big advantages. Speed, tax savings, both in terms of stamp duty and capital gains tax, and also the ability to leverage up. And we'll see in another video that that is the ability to make quite a big profit or loss on a fairly small commitment up front. Take a look at how spread betting actually works. Let's say I've made a decision that I might like to try a spread bet on, say, Tesco shares. How does it work, and why is it different to simply buying some Tesco shares? Well, let's take that option first. Supposing I want to bet on Tesco rising in price today. I could go out and buy myself 1,000 Tesco shares. So maybe I try to buy 1,000 shares and I pay the market price for them through my broker. And we'll take the mid-market price. For this example, we'll ignore the bid to offer spread. That's the fact that my broker makes a little bit of money out of charging me more to buy than I would get if I was selling to my broker. And we'll say that mid-market price is £4.25. So buying 1,000 Tesco shares, nice and easy, is going to cost me, if I really want to buy that many, £4,250. Okay, what I'm hoping is the share price rises. I'll need to make something back because I'll have paid £4,250. I may have paid some commission. I may have paid some stamp duty, 0.5% of that number up front. So I now need Tesco to rise to make some money. And let's say it does. So by the end of the day, the new share price, I've still got 1,000 shares, is £4.50. And I decide to sell my 1,000 shares at £4.50. So that raises, let's say, £4,500. Based on that, my profit, my gross profit, if you like, ignoring commissions and stamp duty and maybe even capital gains tax on the profit, is a decent £250. So I invested around £4,250 in Tesco shares, I've cashed in, and I've made £250 profit, which, if I haven't sheltered it inside something like an individual savings account, will attract capital gains tax. Fine. So you might say, well, that's a good day's work. But there is another way to do this, spread betting, and it has several advantages. Number one, I get around paying that upfront stamp duty. Number two, I don't have to pay capital gains tax on £250 profit, and I can still make £250 profit. And thirdly, I don't need to commit quite a lot of money up front, £4,250 to this trade. I'll get away with committing a lot less. And that's because spread betting is leveraged or margined. And that means, in financial markets jargon terms, you only put a small amount of your total exposure up front down in a cash account with your broker. So, how would that work? Well, the jargon is slightly different. So, this time I don't need to buy 1,000 Tesco shares. What I need is for my broker to quote a spread betting price for Tesco. Now, the expression spread betting suggests there might be two prices, and normally there would be. There'd be a price to buy the bet, if you're looking to place an up bet on Tesco, and a price to sell the bet, if you wanted to place a down bet on Tesco. And the gap between those two prices is the spread taken out by a broker as a profit. But for the purposes of this example, I'm going to assume, slightly unrealistically you might say, that I could buy or sell a spread bet, i.e. place an up bet or a down bet at the same mid-market price. So let's say my broker says, okay Tim, if you want to place a spread bet on Tesco, I'm quoting a price of 425 pence. May not say pence on the screen, but 425 pence or £4.25, and I want to buy that bet. The next thing my broker will ask me is how much I want to bet. And here's a bit of spread betting jargon for you. What you need to decide is what amount you're prepared to commit per point, as they call it. Now, the value of a point varies according to the bet. Here, let's assume 1 point is a 1 pence change up or down in the Tesco share price. Through some brokers it might be less than that, but let's say it's just a 1 pence change. And you can always ask your broker what a point represents. What is the minimum movement in the underlying asset, in this case Tesco, that your broker recognises for the purposes of settling up profits or losses. So a point is 1 pence, and I decide to bet at £10 per point. Now, why £10? Doesn't have to be £10. If you do bet at £10 per point, you are effectively taking a similar position in Tesco shares to somebody who bought 1,000 shares. But you don't have to bet that much. You could bet £5 a point, maybe even less. It's negotiable to some extent with your broker. So I'm going to bet £10 per point. So my broker now knows that I want to bet on Tesco, I want to place an up bet, and I'm betting at £10 per point. So what happens next? Well, maybe I put that bet on this morning, and a few hours later the Tesco share price is 450 pence, or £4.50, just like the last example involving shares. Only this is a spread bet, so here's how we settle up. Having bought the bet at 425, I now sell it to close my position, a bit like buying and selling Tesco shares themselves, and work out my profit. And in spread betting terms, they talk about a 25 point profit. What does that mean? Well, I've forgotten something. I was betting at £10 per point. I could have gone lower, but I chose £10 per point. So my broker will turn that into pounds by saying, well, okay Tim, you were always betting at £10 a point, so that's £250 of profit. Similar to the Tesco shares example actually, where I also made £250. So why bother with this thing? And the answer is no stamp duty up front or anywhere, no capital gains tax to pay on this profit, no commission either to open the bet or close it. I just suffer the bid to offer spread, and the more popular the share, the narrower that will be and the cheaper the trade. Tesco is obviously a pretty popular share. And there's another hidden advantage which isn't clear yet. How much money did I have to put down to place the bet in the first place? Not £4,250 like the Tesco shares example. What my broker will do is say, well, if you're betting at £10 per point, Tim, that is at a share price of £4.25, that gives you the equivalent exposure to someone buying shares of £4,250. So what my broker will then do is say, right, I'll take a percentage of that as your upfront deposit, and I'll keep it in a separate account until you close out your position and successfully settle up profits or losses. Now, the amount of the deposit varies from broker to broker. It varies according to the share you're trading as well. Some shares are more volatile than others. But let's say on Tesco, the deposit required is 5% of the equivalent open position. So my broker might be asking me to pay up around £212, let's say. as an upfront deposit. Now, to be honest, the exact amount doesn't matter. Your broker will calculate that automatically, but it is worth asking what the deposit rate is. So that would be mechanically a function of these two figures, but the principle is important. So in other words, it's only cost me £212 up front to open this bet on Tesco, and at the end, when I close out my position, if I say to my broker, that's it, I've finished betting, no more bets to place, I can expect to get the £250 profit and the deposit back. So I have made a clean £250. And that's another benefit of spread betting. A relatively small deposit, much smaller than buying shares, gets me a similar exposure to the Tesco share price. That's called leverage or gearing. Now, it's also the reason spread betting can be dangerous in the wrong hands, because for a £200 deposit, £212 deposit, what if the share price had collapsed? The answer is I'd be losing £10 a point just as fast as I made it in this example. I could easily be several £100 down in a matter of minutes were Tesco to suddenly go through the floor. And that is a problem, because if I own Tesco shares, I can just wait. I can say, well, actually, if I hold my nerve, they'll probably recover. So I just sit on them and wait for them to go back up again before selling. Spread betting doesn't work like that. You've got to be prepared to fund your losses. So my broker might ask me to increase the size of this deposit. Otherwise, they reserve the right to just close out my position, and that may leave me suffering a big loss I don't want. So that's the problem with spread betting. You can place large bets off a fairly small deposit, that's the upside, but on the downside, you can also lose money fast and potentially be asked to increase those deposits very quickly. Now, one way around that problem in the spread betting market is something called a guaranteed stop. And for novices, it's worth asking your broker about that. It's an order, and what it means is essentially if you place an up bet on Tesco at say $4.25, you agree a price just below that where your broker will get you out of a losing position. So rather than losing £10 a point, almost without limit, as the Tesco share price starts to drop, a guaranteed stop limits your losses. And those are a good idea. They're a bit more expensive than a standard stop order, but they get you out basically at what this suggests, a guaranteed price. In other words, if you want to cap your maximum losses, guaranteed stops are a pretty good way to do it. They will cost a bit of money. You'll find that when you ask for the spread bet price on Tesco, with a guaranteed stop in place, the bid to offer spread's a bit wider. In other words, you're being charged a bit more for that guaranteed stop, but nonetheless quite a good bet if you're nervous about your first few trades.